Thank you for joining us today. We're going to talk about redefining this for the Indian HNI. And we're going to do this by going beyond the traditional portfolio. So we're going to talk about what investors really look for when they're looking at risk management versus the traditional options that they had, whether they really work in today's context or as we get into this, we look at multi-asset investing and a few other things that we can explore along the way. If you have any questions, feel free to type them into the chat box and we can take a look at this towards the end of the webinar. So the first thing that we're going to look at is what is the wealth landscape look like for a traditional HNI? And when we look at how this is, you have equity heavy direct stock holdings. So both the equity as well as the mutual fund portfolio tend to be a little bit more unstructured in the sense there isn't a concrete direction in which these portfolios are built. It's given primarily under the pretext that equity is an asset class that can create the highest long-term wealth, and it's not oriented towards the context in which these ideas are bought into. Specifically with the mutual fund portfolio, what tends to happen is it's anchored very much towards recent performance and what portfolios have done versus what their true potential is. Beyond this, I think what dominates the asset allocation is essentially real estate and fixed deposits. As we move into a lower interest rate cycle, I think it's quite evident that returns from fixed deposits as well as bonds and other debt instruments have actually come down a fair amount. So there is that fear that you're not actually creating wealth anymore with these asset classes. When we look at real estate also, what it does is it preserves rather than creates wealth. So it is not an asset for an ambitious investor. Real estate allows you to create a structured inflow, but it doesn't really allow you to grow your wealth unless you're looking at actively managing it and moving in and moving out of real estate opportunities across market cycles. So what tends to happen to these portfolios is that they end up having some level of concentration risk, either due to overexposure to a few segments of the market. Let's say in today's context, when we study portfolios, what we notice is a heavy allocation to mid and small caps, particularly either in a passive format or in the mutual fund format, where there is an overcrowding of ideas within the same space. You also tend to have concentration risk in portfolios at the asset allocation level because real estate again tends to occupy the largest part of the pie. And this results in a lot of emotional volatility because these portfolios are not actually aligned to either the life goals that an investor has or their actual risk appetite and tolerance that they will experience, right? So this is what we think is broken in the traditional landscape, and there is a need to fix it. And the fix is actually fairly simple. It's not something that's complicated or that is beyond the reach or that is going to cost an investor a lot to restructure. So before we move ahead, I'd like to do a quick poll on what risk actually means to you, right? So I've just launched this poll here. It should appear on your screen. It's a word cloud, which essentially means you're free to write what you think. It doesn't have to necessarily, I mean, there are no options that you need to answer. All right. So I don't see any more responses coming in. So we're just going to go work with what we have. And what we have is that somebody said that risk means loss. And let's try to get a more nuanced understanding of what risk actually means, right? So I think one way to look at risk is to look at it as uncertainty. And this means that you have a range of possible outcomes. And I think in today's context, risk as uncertainty is there in all of our minds, specifically when we start thinking about tariffs and how they play out. And for those of you who are interested, you can quickly scan and read Shyam's market wrap from last week, where we've talked about thinking beyond tariffs. The basic idea being that, so many things can play out from where we stand. And you don't really know how the shape of things is going to appear in some time. And because of this uncertainty that's there, you can't really prepare for each path, because there's a good chance that what you think will happen doesn't happen and something else happens, right? So I think when we think about risk as uncertainty, the most important thing that we need to keep in mind is that we can't predict, but we can prepare. And I think that's a lesson from Howard Marks itself, where the idea is that you can be more defensive in these situations. When you see a lot more uncertainty around you, when you're not sure about how things are going to play out, the idea is to prepare and not to predict, because predicting doesn't really get you anywhere. And then I think we come to what showed up in the word cloud, which is risk as a probability that you would lose money, right? And this can happen in two ways. I think there's a chance that you can either lose money and never recover it. So if you make a low quality investment, let's say in the past on the fixed income side itself, you've had people who've put money into additional tier one bonds. You've had people who've put money into bonds of companies that have defaulted. So when you participate in a low quality investment, what tends to happen is that you lose that money and you're never really going to recover it. The other thing the other way that you could lose not necessarily money, but opportunities in the market is when you go through a time correction. So this is the price chart of a well-known blue chip company, and you've really not seen any movement in 2-3 years time. So if you bought the stock in August 2021 and you owned it until 2024 December, you've really not seen any movement in the stock price. In fact, your returns are going to be negative, or they're going to be marginally positive, in the sense you would have made maybe a 3 or a 4% compounded return in this period. So while you haven't lost money, what you've actually lost in this period is opportunities. And risk can also be measured in this way, though it's very difficult to measure risk in terms of opportunities, because it's easy to see a drawdown or it's easy to see a loss and then be able to measure it. But how do you measure things that you could have missed out on? There is no metric for that, right? So we need to start thinking about risk as loss as well as of money, as well as loss of opportunity. So when we reframe our understanding of risk, we have a better perception of how to manage it. I think you also have risk as the residual unknown, which means that this is what's left when you think you've accounted for everything. So, for example, if we rewind, say, 5-6 years in time and we look at 2020, most investors knew about COVID because you already had some news that was coming around from the US, from China, etc. And things really became serious only in March, and nobody expected that the pandemic would really take over in that sense, right? And this is at a point where you think you know everything. We've not had a pandemic in a century, and so these kind of unknowns can always crop up, right? And I think that in these situations, the way that we manage risk is to be more resilient and to course correct fully. So this is something that you can't predict. It's something that happens externally, but it is something nonetheless that happens from time to time, and we shouldn't be too bogged down by these events. So there's a great blog which I would recommend everyone to read over the weekend by Morgan Housel, where he talks about the 3 sides of risk. And it's a really nice story of how, I mean, it's actually a tragic story, but it's about how he went skiing with his friends, and you know that you're taking certain risks, and you know that you have to manage what comes your way, and you don't really understand what risk is, which is that, we need to recognize that there are three parts to any risk that we're dealing with. The first is in terms of, okay, what are the odds that something will happen to my portfolio or to me? And then you think about, okay, so if these are the odds, then every time something happens, then what is the average impact? And then you need to think about the worst case, which is that if everything goes wrong, then how much do I stand to lose, right? So these tail end consequences matter a lot, because while they are low probability, the impact is what is really going to change how you deal with things. So when we start looking from the investor's perspective, what are real risks for an investor? I think losing money in the long run is a real risk, which means that we need to manage our opportunity costs as well as how we're compounding wealth in the long run. And sometimes if we focus too much on the short run, then we're unlikely to really achieve what we need to do in the medium term. This is why there's a need to shift out of fixed deposits, even in a context where there is so much market uncertainty. An investor navigating out of fixed deposits into market linked instruments could actually be doing the right thing. But if they focus on the short run, right, that is, if you see your 1 month return, your 3 months return, or even your 1 year return, and that is keeping you up at night, then you're sacrificing what you could make in the long run for what you're seeing in the short. The second biggest risk, I think, is in terms of liquidity, which means that you're not able to access wealth when you need it. And this is the biggest tragedy, I think, for an investor. If you've been very diligent as a saver and you've managed to grow your wealth through different asset classes, but all the assets are illiquid. And this tends to happen in a real estate heavy portfolio, that you're asset rich, but you're cash poor, right? So to deal with your needs, you cannot sell a property square foot by square foot. And this kind of property sale doesn't happen swiftly, right? You're always waiting for the right buyer, for the right price, and this could take months or even years to materialize. And even though you're good for the money, you don't actually have it, which is, I think, the real tragedy. So an investor needs to manage their liquidity in line with their aspirations and their goals. And I think the last one is concentration risk. Now we've touched on We've touched upon this in the past, but basically, when you talk about concentration risk, you're looking at fortune swing because of a single investment. And this essentially means that one investment dictates how your entire portfolio does, or one single asset is ruling or dictating what happens to your entire wealth. So there is a need to diversify, but not too much. So then it's a fine balance between having focus as well as diversification. So now I want to walk you through some asset classes, and we're going to first look at the Nifty, right? And when we're looking at the Nifty, the most important thing is that within the first 3 years of your investment, returns vary quite a bit, right? You could see 35-40% returns on a 3 year basis. You could see negative returns on a 3 year basis. And this can actually confuse investors because timing matters a lot. If you extend this timeline a little bit and you move to say 5-6 years, the consistency is a little bit more clear. And you do realize that you're not going to have all negative return years in that time frame, right? You can have a few bad years in between. You can have a few good years in between. You can have a mixed bag as well. But if we extend this a little bit further, right, that confidence and the narrowing kind of shifts out quite well. So if you're looking at 11-year horizon, you're broadly in the there's a good chance that you will earn anywhere between say 9 to 15%. Then when we stretch this to a 20-year period, I think here again your returns become start trading in a much narrower range, and you're seeing anywhere between say 11 to 15% in that frame. And if you move further on, you're going to get a completely positive thing. And you see that returns narrow down to about 12% compounded as you approach, say, 25 to 30 years. And this is a great this is a great learning for us, because essentially what you need to do is that if you're consistent in the long term, you're not going to worry too much about what's happening in the short term, right? So somebody who is very intense and very regular in the short run doesn't really outbeat somebody who's been more consistent, less intense in the long run. And this is the same as, like, the hare and the tortoise race that we know about, because what matters is the consistency and not the intensity. So why is it that diversification actually works? And this is like a mathematical relationship, right? When you have assets of different natures within a particular portfolio, diversification works simply because they tend to move in different directions at different rates. And this means that your portfolio can actually perform in a wider range of scenarios. And when a portfolio is capable of performing in a wider range of scenarios, you're going to see drawdowns that are less sharp. You're also going to see performance in a broader range of events. So when we look at correlation, this is something that's come from Bandhan Mutual Fund, where they've studied the correlation between, say, the Nifty 50 versus global markets, or gold, or even short-term debt. So assets that have a high positive correlation are all going to move together and don't give you that risk diversification that you need. But assets that have a low positive or even a negative correlation actually give you that diversification benefit. So for example, when we study these correlation relationships, what stands out is that equities have a negative correlation with gold, whether you're looking at domestic or even global equities. And global equities are a great diversifier for domestic equities. Similarly, debt and gold have a low correlation. You have a low correlation between debt and equities as well. So this essentially means that when you put a little bit of everything into your portfolio, you're actually making it stronger. You're not dragging on performance. So while we understand that diversification is better, I think we also need to pay attention to the fact that asset classes have sub-asset classes as well. So if you're looking at equity, you also need to pay attention to how the style of the investment is. Are you looking at a more momentum-oriented portfolio? Are you looking at a more value kind of portfolio? Are you looking at growth investing? Are you looking at contrarian investing? So the style really matters a lot. And then, of course, I think an easy way to sort of categorize equities is through market cap, right? So SEBI has gone forward and given us a very clear-cut definition of what large cap companies are, mid cap companies are, and small cap companies are. And then, of course, you can also have sectoral or geographic classifications when it comes to equity. When it comes to fixed income, the classification is a little simpler. You either look at duration, meaning you're going to look at investing in longer term bonds and then benefiting from price movements there, or you're going to look at an accrual strategy where you're trying to look at an income oriented thing. So there you might end up taking some credit risk, or you might end up playing in more short term instruments. Then I think, of course, with physical assets, what you're seeing is real estate, precious metals, or other commodities that investors own. And when it comes to global, I think the two broad classifications could be: are you looking at emerging market allocations, or are you looking at advanced economies? Now I'm going to show you one of our favorite charts, which is the asset allocation quilt. This is something that LifeMint publishes every year, and it's very helpful in understanding how assets actually perform over a period of time. And we'll also illustrate why a multi-asset portfolio can help an investor more than a single asset portfolio. So if you notice, there are so each box represents a particular asset class. and each color is associated with that asset class. And you can see that assets that are at the top of a particular year end up in the bottom in subsequent years. Nothing really stays in the top forever, and that there are opportunities in every asset class. So pay attention to the numbers at the top as well as the bottom. So if we start at the bottom of the table, one thing that we notice is that yes, there are years where everything is negative. uh, I mean, that you have something negative in the bottom. And this essentially means that half the time, more than half the time, your all assets are giving you some positive return. So if we count the number of years in which the returns are positive versus the total number of years that are there, more than half the time, your returns are positive in this time frame. The second thing is, what you notice is on the years where the bottommost number is negative, you actually have assets that are performing positively at the top of the table. Now, this essentially says that there are no years where everything is going to lose money, right? There are years where you might have a bad investment or you might have an investment underperform, but there are no years where everything fails an investor. And I think this is an important takeaway. So if we look at how these assets perform and we say, okay, let's say an investor invested only in gold, then their compounded return over this 14-15 year period would be around 9.5%. If they invested only in debt, then their return would be closer to 8%. And if they invested in equities, their return would have been closer to 11%. So the basic idea is that if you blended all of these, you would have benefited from years of great investment from different asset classes. So going back to the chart, I think one thing is there's no year where everything fails an investor. The second is more than half of the times all your assets are going to deliver positive returns. And the third is that your losers can become winners and winners can become losers. So there's no need to focus on only one strategy or solution. So now coming to the myths versus the reality. So I think one common perception is that, you know, if I diversify, then my portfolio is risk-free. But the truth is that diversification can help you reduce risk, but it can't eliminate risk overall. Meaning there can be market-wide events that affect your portfolio. I think in the beginning of the presentation, we talked about how COVID affected investors, right? So on the day that equity markets corrected, even a precious metal like gold corrected. And this is because markets are interlinked. You do have margin calls, you do have liquidity calls that come in at that point. So investors sell whatever is available. So there's nothing that's going to prevent you from temporarily losing money, but diversification does give you some strength and does give you different sources of performance, which is always better for an investor. I think the next thing is that if you have more assets, it means you have better diversification. And I think what we need to understand is it's not about the number of assets or the number of securities that are there in your portfolio. It's really about how different they are from one another. And this difference is measured through correlation. So if you have a portfolio of assets that have low correlations with each other and negative correlations, then you're getting a better diversification strategy. Whereas if you're an investor who is diversifying in sub-asset classes or diversifying in asset classes where the correlations are positive or moderate to high, then you're not really diversifying to manage this, right? You're diversifying maybe for mental peace of mind, but it doesn't really help you in the risk management part. Of course, coming back, I think diversified portfolios can lose money. That's not something that we should expect from any investment. But what happens is that the recovery tends to be a little bit faster. So if we look at a diversified portfolio, you may see a drawdown, and I think we will be sharing some drawdown data as well with you a little bit later on in the presentation. And that can give you some visual representation of how recovery happens faster with a good asset allocation strategy. The next concern is probably so these concerns typically stem from more conservative investors, but let's also look at things from an aggressive investor's perspective, right? So one main thing that stands out is that people think that if they diversify, their returns will dilute. They'll tend to earn less, especially because we saw that long-term return, and we saw that, say, an asset class like gold gives you a 9% return, an asset class like fixed deposits or corporate bonds would give you an 8% return versus the Nifty, which is able to deliver 11% return. So I think what diversification does is that it does not dilute returns, and neither does it guarantee them, but it does tend to smoothen out returns over a period of time. So your compounding rate tends to be a little bit more range bound, and that is what gives investors the confidence to participate continuously. And there'll always be something that can do well for a portfolio. Lastly, I think people assume that gold and real estate are always safe diversifiers, but I think we need to acknowledge that real estate is an illiquid asset class. It's not easy to get in and get out of. And one of the risks that every investor needs to think about managing is liquidity risk, meaning what is the point of having the wealth if you can't access it? And most importantly, especially because in today's market, gold is getting a lot of attention. I think gold may not always perform well in all cycles. That is something that needs to be said. There have been periods where gold returns have been negative, and I'm just going to go back a couple of slides and show you this. But if you look at this quilt, right, and you look at performance from, say, 2013 to 2015, net, the result for an investor, a gold investor, has been negative. You've lost almost 20% in 2013. You've gained another 2% in 2014, and then you lose another 8% again. And the following year is still only you're making about 11% return. So this period has actually been challenging for investors, and it followed a period where gold actually performed reasonably well for investors. So I think this is something that we need to keep in mind, that cycles are there in every asset class, which means that when you enter and when you exit actually matters a lot. So when you look at smart allocation, you basically want to mix uncorrelated assets because this ensures that you get some level of diversification and that you're able to fall less than the market and recover also faster. So diversification can be sectoral, geographic, or even at the asset level. The basic idea is that when you look at sectoral diversification, you're spreading your investments across industries. So industry specific or sector specific shocks are minimized, right? If you look at geographical diversification, this essentially manages some level of domestic macro or political risks. When you're looking at asset class diversification, you're able to balance the three pillars of growth, safety, and stability for an investor. So what investors actually need to do in today's context is to look at how they can rebalance and drive smarter investing, which means there is a lot of attention that needs to go into risk control. So this essentially translates into an investor being able to look at how much risk they're taking, how they can respond to risks that they haven't factored into their portfolios, and how managing this risk can actually keep their financial security at a much higher level. The second thing that you want to look at is allocation discipline, which essentially means that are you participating in the right asset class at the right time? This is closely linked with profit booking and adapting to market cycles. Now, profit booking is something that many investors miss out on, and it's something that we should be paying a lot of attention to today. When you are booking profits, you're actually creating wealth and you're creating liquidity to participate in the next winning asset class. What tends to happen is we tend to hold on to our winners longer than we should, primarily because we feel that we don't want to give up on a winning horse, right? But cycles essentially dictate that the winning horse is going to change as the game also changes. So investing needs to be more opportunistic and needs to be more merit based rather than past performance based. And rebalancing will essentially allow you to create wealth as well as create room to create more wealth. Now coming to the last thing, which is measuring risk. I think, in today's context, there are a lot of investors who ask for particular data points. So I think if you're looking on platforms, you will see things like beta or Sharpe ratio or Sortino ratio. And these are nice terms academically. But I think when we're being more practical about risk, the early definitions that we discussed in this presentation are actually more practical, right? Meaning, at the end of the day, as an investor, what I care about is how much am I losing? Is it affecting my sleep? Do I have liquidity? Meaning, can I use this money when I need it? And I think what you need to look at beyond beta and these other metrics is basically how much drawdown control does the portfolio have, meaning when markets crash, what's happening to my portfolio. You also want to look at liquidity, meaning that when I need money, will I be able to access it? And you need to look at correlation, which means that, okay, overall in my portfolio, am I well diversified? Right. So when it comes to risk metrics, I think some risk metrics are more investor friendly. So if you look at max drawdown, you're looking at from the peak to the trough, what is your largest decline? And this kind of gives an investor as to, okay, what is the worst case loss? And the most important thing is like, even in max drawdowns, you can see a different drawdown in the future, but it gives you some rough idea of how stressful investing can be at the worst times. So the longer a product has history, the more drawdowns it would have seen. And this would give you a good sense of how the portfolio performs in difficult situations as well as recovers from them. Then you're looking at upside and downside capture, which is essentially that how much does the portfolio, how much positive performance does the portfolio capture when the market is moving up, and how much negative performance does the portfolio capture when the market is moving down, right? And your upside to downside essentially allows you to measure what is the ratio of these two things, because sometimes you might move more than the market and you might also fall more than the market, which is similar to, I think, like metrics that we have for Sphere. So I'm going to show you the drawdown data, which I referred to a little bit earlier in today's conversation. And if we look at this, I think the recent period that's in everyone's mind is the September to March phase, right? So if we look at this period and we look at, say, the Nifty all-time high to the Nifty all-time low, the Nifty fell about 16% at this point. The multi-asset NSE multi-asset index fell around 8%, and Sphere fell around 10%. But if we look at the same data and we look at, say, Sphere's drawdown from Sphere all-time high, which was the same as the Nifty all-time high, to the Sphere low, which happened a little bit earlier, right? You see that here the drawdown was slightly deeper for Sphere, meaning we were at 10.5%, the Nifty was close to 12%, the multi-asset index was at 6%. But the recovery also in Sphere happened quicker. So, and you can see this with our performance data as well. We've been able to consistently beat the benchmark, especially in the longer periods and even in the shorter periods. But I do think that keeping performance in mind, we need to look at performance as something in the range of an inflation adjusted return rather than an absolute return in this sense. And I think even when we're looking at what kind of returns we should anchor to, I think going forward, given that you're moving into a more difficult phase for markets, you need to be more risk focused and you need to have better risk control and be a little bit more conservative in allocation. I think what would work out in terms of a return expectation would be anywhere between 10 to 12% compounded. And that's also in line with how you want to look at inflation adjusted returns. So what is it that we wanted to do when we ideated Sphere? We felt that investors were worrying a lot about whether it's a good time to participate, whether the markets are going to correct, when should they really put a lump sum in, where should they invest, how much should they invest. So we felt that these were all things that an investor doesn't really need to worry about, especially if we're able to curate a multi-asset strategy that allows them to forget about all of these things, right? So it's always a good time to invest when you have a multi-asset strategy, because there'll be some asset class that's worth participating in. You don't have to worry about when to scale up investments. You can participate as and when you have liquidity. And because you're working with a fund manager, you don't have to worry about where to invest either. That responsibility is delegated to somebody else. And similarly, you don't need to think about how much to invest, because the position sizing is something that the fund manager can take care of. So this is how we are able to challenge the risk reward equation, because I've shown you data points where our drawdown has been less, our performance has been more. And this is a result of a very strong process in terms of following a value and contrarian philosophy in multi-asset investing. And this is how we're able to challenge that low risk, low reward sort of expectation into a moderate risk, high reward expectation. So if we look at where we operate in terms of risk, I think we are somewhere between a conservative and a moderate strategy. Our return expectation should be, say, 5 to 7% over your average inflation number. And if we look at where our inflation is today, I think you're expecting inflation to be closer to 4% in the coming year. And that would mean that a 10% return is actually a good number to expect from a product like this. So lastly, moving on to the terms of investment, if you're an investor who's interested in Sphere, then we are a SEBI registered PMS, which means the minimum investment is going to be at 50 lakhs. We our chosen benchmark is the NSE Multi-Asset Index 1. We don't charge an exit load for any investor, and we operate on a fixed fee model of 1.5% of the AUM, which is computed on a daily average basis, and it's charged on a quarterly basis. So that fee is split into 4 payments in the year. Over and above this, you would have GST and any other actual expenses, which is pretty standard. Who is this product meant for? It's meant for anybody with a conservative to a moderately aggressive risk appetite. It is also meant for investors with a minimum expectation of 5 to 7 years in terms of how long you want to stay invested. The basic idea, even though there's no exit load, is that when you experience multi-asset investing, you need to actually go through a market cycle, and that only happens if you give that time. So that 5 to 7 years gives you a good period of time where you're going to make those returns. Beyond this, I think we have a very flexible mandate, meaning we can allocate to any asset class between 0 to 100%. And we do run a slightly more concentrated approach where the single stock exposure limit is not to exceed 25% of the NAV of the portfolio. But that's a very high cap, and we don't have any exposures even close to that. So with this, our presentation comes to a close, and I'm just going to quickly run you through the takeaways. So I think the first thing is that wealth is not just about returns. It's about how you manage risk in an effective and smart way. Diversification across asset classes is what can create wealth for you in a manner that gives you a lot more peace of mind. And lastly, when you simplify decisions, then consistency becomes easy, and we saw earlier how consistency beats intensity. So I think what I would like to leave you with is that rebalancing your portfolio to ensure that it stays aligned with your goals, your risk tolerance, as well as the market context is what can create wealth for you and do that set shift. So I'll open up for Q&A. If anybody has anything, I'm happy to take questions. Thank you and have a great weekend.